So I'm going to talk about corn exports, and it's a big topic. You know, we could probably turn this into a semester-long course if we wanted to, of Dr. Olson's or Dr. Wilson's. I don't think anybody really wants that. So in the interest of time, we're going to focus on the PNW and try to tie it back to North Dakota a little bit, keep it relevant. So a couple of takeaways that I hope to impress on you here. We're going to look at just the current marketing year, what we've done historically off the PNW, really focus on the seasonality of PNW exports, because for the PNW, where, like Sam mentioned, capacities aren't necessarily available at all times of the year, we're also not shipping to as wide a range of destination markets as other origins like the Gulf, for example. It's really important that whenever the PNW is competitive into those East Asian markets, that we take full advantage. And that means that we have commercial stocks in store and ready to ship. That means that we need our, obviously, prices to be competitive, but we need our transportation partners to cooperate as well. So we'll touch on that. We'll touch on, take a look at the share of exports between the PNW and the Gulf and other origins, just to kind of give a high level glance at what the PNW can really accomplish in a given year. Focus on those core customers, and we'll talk about rail challenges and some other things at the end. So here's a quick look at just cumulative export sales to this point. You know, 21-22 marketing year is mostly wrapped up as a pretty solid year. You can see this is over 2 crop years. So you can see back in May of last year and September of last year, we had 2 unprecedented bouts of really large export sales announced, both to China. I think that May 7 to May 20 time frame there was like a 9.3 million ton announcement, which was obviously very large at the time. And both of those were fortuitous, to say the least, in hindsight, you know, given what happened when Russia invaded Ukraine at the end of February this year. For marketing year 22-23, you can see we're not, we haven't seen those kind of sales that we saw last year, but we are ahead of pace for this time of year. The next few weeks are going to be pretty critical. You can see that's when sales, when our book starts to break out. We know a little bit more about the crop. We get some producer engagement. The exporter starts feeling more comfortable offering grain into the marketplace. And usually that's when stuff starts to take off right as we get into harvest there. Here's what this year to at least through June of the marketing year has looked like in terms of export volumes out of the major port areas in the US. You can see the Gulf dominates, as you'd expect. Interior in gray there is mostly Mexico, and this year Canada, as everybody's pretty well aware. I don't have it broken out here, but Canada takes up a pretty good portion of that interior export volume. I think the final number of corn exports into Canada this year will be somewhere around the 4.5 to 5 million tons range, which is 2.5 times average. The upcoming crop year, I don't think that we expect to be as robust volume-wise, but there's certainly going to be a ration for corn in areas like the Lethbridge feed market, and obviously the rest of the growing season has to play out, but we'd expect corn to work its way into Canada again, just not in the same kind of fashion. The PNW there in blue is really what we're going to focus on. You can see we're crowded out in September, October, November. September, there aren't any stocks really to ship anyway. October, November is all about beans. December is really where we start to get a program rolling, assuming we're competitive. And you know, just as that coincides with the drop in you know, bean volumes off the PNW and opens up elevations for commodities like corn, you see Brazil switch to a bean export program as their harvest picks up in January, February. And then usually in May, June is when you start to see the Argentine crop hit the market. And this year too, we had to compete a little bit with South Africa, which raised a much better crop than average. For the PNW specifically, here's what it looked like on versus the last 5 years, I think this chart has. It wasn't anything exceptional, pretty average year overall. We had the spike in May that was really the result of the Russian invasion of Ukraine. And we'll see where that stuff was exported and what that breakout of countries, of destination markets for those volumes in April, May. But it was a slow start. Again, bean elevations were really strong. There wasn't any room for corn. And we kind of found our average there as the year went on. As far as July and August exports go, wouldn't expect them to be any better than June, certainly not August. July could be kind of on par there, maybe 1 million tons, but overall nothing to write home about. Here's a quick look on an annual basis of the share of exports, Gulf versus PNW. You know, you can tell in a good year, we're going to have 15 to 16 million tons of exports out to PNW. That's about as much as we can do. If you look at 2017 and 2020, those crop years were both on the heels of, in 17-18, a poor Argentina crop, and in 2021, a poor Brazilian crop, in addition to the ongoing trade war with China, which resulted in them purchasing a big chunk of U.S. product, including corn. But really, without those kind of market conditions that are adverse market conditions in other parts of the world, it's tough for the PNW to really capitalize fully on their export capacities for corn. So here's a look, just a quick look. I have a few charts like this that go back to 15, 16, which is arbitrary, but it's useful just to see the seasonality. You can tell, again, as far as export capacities and seasonality of PNW exports, you can tell here, you can see where beans take over, right? And they're having the same effect in the Gulf, but the Gulf is going to export corn year round. You can see the baseline for corn exports out of the Gulf is going to be 1 million tons, even when they're getting after it with soybeans. For corn, we don't have those kind of capacities to throw around. So as soon as beans are wrapped up, it's important that we have prices that compete into those markets that we ship to and that we take full advantage. In 17-18, you can tell we did that, and in 2021, you can see we had our moments also. This year, 21-22, again, wasn't exceptional, even with the crisis in Ukraine. Just another way to look at it there, in the best of times, PNW versus the Gulf is going to be somewhere around 30% of the export volumes out of both. Here's another glance at, I wanted to talk about our key customers out to PNW and what we're looking at for volumes potentially this year. You can see I included a number of countries for the Gulf, which is really just to show, again, the diverse range of destination markets that the Gulf can ship to relative to the PNW. There are a number of countries listed under PNW, but really only 4 that matter. In any given year, you're going to have Japan, Korea, Taiwan are going to be your top 3. And China here the last couple of years has played the wild card. So here's what that looks like in terms of volumes. I've highlighted Japan and China because Japan is typically our most important buyer, and China here in the last couple of years has come on strong. But again, PNW volumes, PNW capacities for corn really rely on competing into these markets. And our stiffest competition is always going to be out of South America. We'll touch a little bit on what's going on between China and Brazil in a later slide. But as soon as offers are cheaper out of, say, Brazil or Argentina, buyers in Japan, Korea, Taiwan are going to make the switch. So if we look at, take this year, for example, after Russia invaded Ukraine, the market clammed up pretty much on all fronts, whether it was track corn, FOB offers out to PNW or any port, freight. Everybody went no offer, wanted to let the dust settle a little bit before we figured out what was going to go where and what the ramifications were. We saw a little bit of a surge in demand in April, May from countries like Korea, which we'll skip over here real quick. You can see this is a breakdown of exports by country off the PNW by country. Korea and China numbers jumped quite a bit there in the May time slot. So when that happened, when Russia invaded Ukraine at the end of February, everybody went no offer. There was a big expectation that volumes were going to switch to the PNW among other origins. But for countries like Korea, Japan, Taiwan, there was an expectation that we were going to see huge volumes switch over, and some did. But that expectation at the beginning was that it was going to continue through the summer. And while we put that additional business on for May, there wasn't any follow through for June, July. And that's because through the months of March and April, we started missing business to those countries, to Argentina, to South Africa. I mentioned South Africa had roughly an additional 30 boats of export volumes this year to ship. And that kind of took the wind out of our sails for June, July, and didn't really allow us to capitalize on volumes that could have been there at the margin. There was the expectation at the time too that that demand surge, we would see it in new crop as well, and it never really materialized. The other part of that is when that happened in February, like I said, markets all clammed up and went no offer. Freight markets rallied from secondary market for shuttle freight on the BN rallied from trading 200 under in the middle of Feb to trading 3,000 over nearby in mid-March. So when you spiked in the risk premiums for freight, it wasn't just in the nearby position, it was all the way out. So that was just another barrier to business for us for the months of June, July, where the market didn't quite know how to price shuttle freight. And we had an additional 20, 30 cents of risk premium added to FOB offers there that probably didn't need to be there in hindsight. So we started missing business, and ultimately you can see our June volumes dropped quite a bit versus May. So here's a look at PNW capacities between corn and beans, or PNW elevations. You can see I wanted to overlay the beans on top of corn, but it just looked easier on the slide, or looked better on the slide how I separated them. You know, in a perfect world here, this upcoming crop year, we'll take full advantage of our bean program in October, November, December, like we did here this past year where we had record volumes. And as soon as that wraps up, we'll be able to capitalize with a year similar to 2021 or 17, 18, and really maximize our volumes on both the bean and the corn front. That's to be determined, obviously. The crop in North Dakota is a little bit smaller than we'd like. Without the acreage being there, conditions look decent. There's still definitely yield potential, but the PNW doesn't rely as much as it once did on North Dakota volumes. South Dakota, we'll see what happens there, but they're in a little better shape. Parts of Minnesota are in better shape. But Nebraska has been a big player for both corn and beans to the PNW in recent years. And we'll see with the dryness that they're experiencing, the irrigation definitely does help, but we'll need big volumes out of Nebraska to really support a program there. The landscape as it stands right now, we're not competitive in any position off the PNW until late December or early January, where we're on par with FOB offers out of Brazil. Not that there's any business really getting put on. There hasn't been any producer engagement for months as everybody's tried to give the crop a little bit of time to develop and see what they're dealing with. And with the board dropping like it has here in recent weeks, that doesn't help things. So we haven't really put on any kind of a book for new crop. The hope is that as soon as Brazil picks up their bean exports and drops corn in January, February, that the PNW will be the market, and we should be for those months, JFM. April, May, as you get into Argentina's crop, again, we're expecting big crops, and you have to expect big crops in South America until you know otherwise. For all intents and purposes, we'll probably again be crowded out of that market off the PNW due to Argentina stocks come May, June of next year. So the hope is that we can capitalize as much as possible in the months of JFM and April, May. The biggest hurdle to that, as you can imagine for those months, because it's the winter months, because weather becomes such a factor for transportation, we'll talk a little bit about rail, because this is whether you're on the BN, the UP, the CP, whatever railroad you've been tied to here this year, you've had challenges. Going forward this year, Sam talked about how rates are up 20 cents a bushel on spring wheat trains going to the PNW, I think he said. For corn to the PNW out of generic North Dakota origin, we're looking at an increase of 30 cents a bushel. Won't help us compete, but that's just another hurdle that we'll have to get over. In addition to the increase in our tariff and fuel surcharge, we have secondary market freight costs to consider. So here's a chart of, this is nearby shuttle freight values on a calendar year basis dating back to 2019. You can see what we've experienced here this year and the convulsions that came with Russia's invasion of Ukraine. So I'll give just a quick narrative on this year here for everybody's sake. We started out with a really choppy harvest. You know, the market's expectation, like we saw here in 2020, I think that was, is that crops will come off at the same time from Nebraska, South Dakota, all the way up through North Dakota and Minnesota. That didn't happen this year. Beans were coming off in Nebraska, but it was another week or two until the Dakotas started taking them off. Rail freight was really choppy to begin with, and in October 10th, we were trading at 100, 150 under a car, which is unprecedented in a normal soybean program. We rallied a little bit as corn harvest picked up. You can see, but mostly we were steady. Anything in this range, when you're trading from tariff to $500 a car or something, that's very manageable for the industry. What happened in December here, if you recall, the polar vortex hit. We had temperatures again in the 20s and 30s below across the northern tier. And then we ran into the holiday period. And weather is an issue every year. You can see that in 2019 with the polar vortex event that we experienced then. But this year, more than others, crew problems and crew availability on the railroad is probably our second biggest concern next to the weather. So we had this huge spike in December and January in the midst of a big soybean program and the start of corn. We had wheat in the mix also. So it was a very busy program up the PNW, and freight spiked to $3,000 a car. Quickly sold off as soon as the weather subsided. And you can see what I talked about earlier, where we were trading 200 under cancellation values in the middle of February, just because the prospects for business out the curve were starting to diminish. There really wasn't anything to get excited about. And then Russia invaded Ukraine. And you can see pretty much the exact timing of that here in the market's eyes, a sharp jump in freight values from those negative values all the way up to, you know, this is really, this chart is really just the middle of whatever the bid and the offer is at any given point for freight. So you had $1,500, $2,000 bid-ask spreads at this time. The market just didn't quite know what to do. You can see this drop here. Anytime you get into April, May, or you start to get close to that, the market just expects things to drop off because of the loss of volumes off the PNW. And so there's always this kind of anxiety in the market to look for that first opportunity to sell off, because values at these levels, it's just not sustainable. You can't trade grain at these levels. Everybody loses money. It really hurts the industry. And you don't want to be left holding the bag at the end of the day. So I think that this drop coincided pretty closely with an actual, I think it was a week or two of what we considered, the market considered better performance by the BN, and things sold off pretty sharply, only to rally right back to where it was. And we stayed there for another few weeks. And like I said earlier, trading freight at those levels in the nearby, you're certainly going to price in additional risk premiums in the deferred months. Maybe not as much, right? But that curve is going to look something like this, as opposed to a sharp drop off like what we actually saw here. We had a couple spikes recently in June as we were working through the last of the big volumes off the PNW. But recently here, we've We've idled capacity in the PNW. There isn't a big program on. There's some domestic business still taking place in California and West Texas feed markets. There's a Mexico program, but overall, there's just not enough volume to support the amount of trains that we're running out there. And so we've gotten back to more cancellation values. But these levels here are gonna, anytime you trade up above $1,000 a car, so it's usually going to be an inhibitor for further business out the curve, which we saw this year, no doubt, around the margin. So we talked about crew problems. I do want to share just a couple slides. This slide shows the number of grain trains holding, and I've got it charted on a crop year basis. But this shows the number of trains holding for one of two reasons, either power availability or crew availability. So anytime, probably the biggest driver of problems on the railroad, especially in times of high demand, are trains sitting when you expect them to move. And so what's the reason for those trains sitting? It's usually going to be power, it's usually going to be crews, but what's the breakout really? You can see here for locomotives is not the reason. Locomotives are the cause of, on average, 2 to 3 trains holding a week. It's really not the primary driver of trains sitting in dwell. It's people. So this is a problem that the railroad industry is facing, just like a lot of other industries in the country. It's very difficult to find people that want to do this kind of work, and the industry is suffering as a result. So you can see the spike around the holiday, the Christmas holiday. We also had the new attendance policy that was rolled out by the BN here this winter that didn't play well with their employee base. So those are some of the challenges that we've had to deal with. Hopefully, the market's hope is that the BN and the CP, the UP, because you can plot these same charts for other railroads, will learn from these experiences. We're hoping that we're telegraphing as well as we can to the railroads that we're in for another big October-November bean program, that we're going to need people on the ground to move trains. I'll leave you with this slide here. This is a look at employee counts at the BNSF over the last, I think it's since the start of 2016. No doubt there's a general trend here that you can pick up on, and it started before COVID ever hit. You can see we reached our peak transportation and overall employees in the fall and winter of 2018, but that started to drop off pretty precipitously there, and it really in tandem with the rail industry embracing precision scheduled railroading and prioritizing operating ratios above all other metrics, getting costs down as much as possible, which usually means people in power, and getting revenues up as much as possible. And so that's kind of what the industry has been dealing with. Hopefully we can turn this around a little bit and be in a better position come row crop harvest, and really be able to take advantage not only of the bean program that will certainly be there, but hopefully be able to take advantage in the months where the PNW competes for exports, JFM, April, May, and be able to execute up from a transportation perspective. So I think that's it here, if there are any questions.